Ladies and gentlemen, today we have a very special guest to our Property and Finance podcast, somewhat of an Australian celebrity these days, Simon Cohen, founder of Cohen Handler. I thought it'd be great to bring Simon in because he's on the forefront of the property market at the moment. He's dealing with both buyers and vendors that you've had a long-term relationship with, seeing a lot across different markets. There's markets within markets as well, different price points within each market. There's different things happening. So I thought, nothing better to get someone who's across all these markets to come in and sort of speak about what they're witnessing. Lots been happening the last few months. Lots happened in the last 24 hours. We saw the US Federal Bank increase interest rates last night by 75 basis points.
Yeah,
which
big
is
jump.
Yeah, which is quite scary. That's also not long after our RBA last week increased interest rates by 50 basis points. I'm personally going to say we probably will see another 50 points next month, purely off the back of the US increasing so aggressively, because we do need to somewhat follow suit just to maintain our dollar and keep our bonds market looking attractive. But yeah, look, enough about what we're seeing. Let's talk about what you're seeing, Simon. What's going on in your world?
When you use words like scary, I feel like you've been reading the newspaper.
Yeah, the news is definitely taking advantage of the situation. Gloom and doom, nothing sells best than fear, that's for sure.
Of course, but when I'm out there in the market, there's still a lot of money and a lot of confidence. There are properties selling for far more now than they were a year ago or 2 years ago, reselling for more. You really have to know how to pick what you're buying in this market, because there's some of the market that's dropped and you're getting fantastic deals, and there's other parts of the market that are still super strong and highly competitive. But the one thing that there is that we haven't seen in a long time is opportunity, right? And as you know, opportunity doesn't last very long. It doesn't stick around very long. But I'm seeing two schools of thoughts, right? People who want to jump into the market and people who want to wait for the bottom. The people who wait for the bottom will never pick it. None of us are that smart.
No, never.
Unfortunately, I wish I was.
Even the best investment bankers never pick it. Just on that, there's two things I want to touch on. So yeah, one, you mentioned a good point. These windows of opportunity where there is a bit of a downturn in the market historically are always short-lived. I think we've got some data from you on that, which we'll share in a second. But two, you mentioned, at different price points, different things are happening. Can you maybe elaborate on that?
Oddly enough, the top end, the luxury end, that's the strongest market at the moment.
Which is what? Where does that kick in
I'd
from?
say 10 million plus. And the higher it gets, the more competitive it gets, which is interesting. There's more people with more cash than I've ever seen. Even though on paper a lot of people have lost money, a lot of people have made money, but then there's some of them who've lost a lot of money on paper and are sitting tight. But there are a lot of people who want to put their money into luxury property. But then the low end, the sub $2 million stuff, we've seen come off a bit, and there's real opportunities there.
Yeah, so the opportunity market would be sub to both houses and units?
Absolutely. I mean, it's hard pressed to find a house in Sydney, but in other areas, yes. But what's interesting is rents are super strong. So it's gone back to that sort of great yield play opportunity again. And also because prices dipped, good, if you're buying in the right areas, good capital growth.
Well, they would say fundamentals of economics are that if interest rates increase, then so should rental yields, which we're definitely seeing.
Definitely.
I've had some clients sort of switch between properties they're renting at the moment whilst they're still house hunting, and a place that would cost them $1,100, $1,200 a week is now costing them $1,300, $1,400 overnight straight away. So we're seeing that already. Just elaborate back on that, sub 2. There's also a bit of a sweet spot in the houses, sort of 2 to 5, right? We're seeing some less buyer activity there.
If you take like North Bondi semis, for example, last year and the year before, there was a frenzy, right? They were 4.5, 5.5 million. You're now seeing them more at sort of 3.8 to 4.5. So there's definitely been a heat out of the marketplace for that sort of thing.
Which is just normalising, right?
Exactly. It's just normalising. And when people say the market's dropping, and one thing in this graph we'll talk about, it did grow 20%,
which was just not realistic,
But it's exactly the same thing for me as interest rates. Like interest rates are the lowest they've been in how long? for me forever.
It's record
Right.
lows. It's forever.
Like when my parents moved to Australia in 1986, they were 18%, right?
Yeah.
So when
And they always remind you of that, right?
yeah, always. We used to walk to school. Anyway, it there's this fear that they're climbing, but they're still so low. It's like, the way I look at it is, one day interest rates were $20. Recently they've been $1. Now they're $1.15. Like it hasn't gone up very much, but the press, people, like there's all this fear around. But if you think about it, they're still historically incredibly low. And as I'm sure you've explained a million times on these podcasts, the banks have built in these buffers.
Yeah, exactly right. That's a good point to highlight.
We live in a safe country.
The media is really selling on fear at the moment, and they keep talking about that banks haven't or consumers haven't calculated affordability of higher interest rates, nor have banks. That's completely false. Banks have put assessment rates on since pre-GFC times. They put a buffer on affordability, and they always have. Up until 2019, that assessment rate was 7.25%. So they were calculating people's affordability at an interest rate as 7.25. Yeah. Now it's been the last couple of years as rates went down, it's been around 5.5%, which I still don't see the variable rate getting to in the next 2 to 3 years. There is also talk that they're going to aggressively increase rates this year and next to put a hard stance and stop on inflation and consumer spending. But then in 2-3 years' time, they might try and stimulate the economy again by decreasing rates again. So, look, I think it's opportunistic right now to be a buyer. It's definitely turned from a seller's market to a buyer's market, that's for sure. Let's share this.
I agree with that, and I wish it was more, but I do think it's pointing in to make the point that there is still competition out there. You can't just have your pick of any property. And the majority of property is still selling off market. Like if you hopped on Real Estate or Domain today, you'll see very little online.
Yeah, and that's the problem. There's always just a lack of supply in the Sydney market in particular. So we've got this graph that you kindly
So I'm not
together.
really a graph person. I don't really want to be super boring, but it just kind of makes a point, right? And this graph goes back to, I think when we have it open, I'll double check. But I think when I started my business in 2009 in the GFC, right?
Yeah.
And what happened to property prices then? And remember, graphs like this, and when people talk about highs and lows and dips, it's across the entire board. It includes units in high-rise buildings to waterfronts. It is everything, right? The more blue chip, the less impacted. But during the GFC, we didn't see very much. Post the GFC, you see a spike in the market. If we fast forward, if I look at COVID, there was maybe 2 months there where my smartest clients bought, right?
Which was that March till July sort of.
They literally bought things that doubled 3 months later.
Which was once again a very short window.
Very short.
That's also quite a unique situation. But back to GFC, back to 2019.
GFC
also
was short too.
Yeah, well,
the market dropped, I think 6% from memory. I can't really see the graph.
Yeah, I'm trying to zoom. I've zoomed in here for our listeners who can hopefully.
It was
viewers.
between 6 and 8% across the entire board in the global financial crisis that property prices fell. That is so little.
Yeah, so you can see where Simon's highlighted that for us. GFC right there, 2007, 2008. We saw about a 13. Oh, that's a 13% bounce back, is it?
It went up 13% after.
And what's funny also, so interest rates have been going. I feel like I'm harping on about interest rates, but it's very relevant, obviously, to what's going on globally. Interest rates have been on a steady decline since the GFC. The cash rate in 2007 was 7.25. 2008 was 7.25%. The general trend's been down, although there was a brief window in 2009 and 10 where rates went up. The cash rate went from 3% to 4.75%. And ironically, the property market in New South Wales actually rallied. It went up 20 to 25% in that period. Not saying that's going to happen right now, but it just goes to show that we can't always
doesn't correlate
directly correlate
Yeah.
that over the next few years, if rates are going to keep going up, doesn't mean the property market for the next few years is going to keep going down. I think right now the bigger issue is just consumer sentiment.
Let's also remember, if we look at the end of that graph, prices went up 22.4%, right? And they've fallen.
Can you see that?
No.
22. They've fallen 14 after 22% increase.
So the market's still not dropped lower than where it's been before, right? And again, that is across the board. You won't see those drops in blue chip areas.
Yeah, they're still
and major cities.
The blue chip areas still stay quite buoyant, right?
Always.
Yes.
This graph makes it look a lot more dramatic than it is.
So there's something else I'd love to show in some data as well that I've spoken about with our referral partners recently, which is about you just touched on it. At the start of this segment, there's a lot of people with a lot of cash right now.
Oh my God, I've never seen more cash.
And what people don't realise is that through COVID, with what I say emergency interest rate sort of lending, the cash rate was at emergency levels just to stimulate the economy. That was globally as well. That's why we're seeing inflation globally becoming an issue. A lot of people through that emergency interest rate environment managed to save a lot of money against their home, or save up a lot of savings in their offset, or also make quite a lot of repayments off their mortgage. So I've got some data on that, which is worth showing if I can bring it up in time. But yeah, just on that note, you're seeing a lot of that, right, Simon?
I've never seen more cash. And what's interesting on top of that is I think a lot of people's earnings went up over that period. A lot of people's businesses did well, investments did well. So they're a lot wealthier than they've ever been.
There we go. I've now got it on the big screen too.
Oh wow!
So we can see that.
Done that for me.
So yeah, I agree with everything you just said there. So you can see there in 2000 and 2021 that purple sort of graph is, or purple section of the graph is extra savings.
The highest.
It really
ever.
really jumped up, and you can see from 2015 all the way till now. All the way till
there was zero savings.
There was no savings. Yeah. That's when people were really borrowing.
In 2018, people were in some trouble.
Exactly. So people have got.
What's interesting. Sorry to interrupt you.
No,
but you
go
look
for
at
it.
that, and then you read these newspapers about doom and gloom, and houses are going to be repossessed. But people are in a safer position than they've ever been in.
Yep, and that's not just. We're not looking at one section there being the affluent of the eastern suburbs. That's the Australian marketplace.
Yeah. Wow.
You can also see, so this also as a share of household disposable income. You can as a percentage on the vertical sides of the graph. You can also see excess mortgage repayments and scheduled mortgage principal payments also increase. So meaning through COVID, people paid off their loan a lot as well. That's also because typically is the key word, through a lower, when banks lower interest rates, they don't necessarily always lower your repayments. Sometimes your repayments stay the same,
right?
But you pay less interest and more principal. So
right.
A lot of people through the last 2 years were aggressively paying down their debt without even knowing it. Tell us.
Do you reckon, out of interest,
yes,
most people actually know how much they owe on their home loan?
Yes and no. They don't know.
Like if you questionnaire 100 people, how many would know the answer to how much do I still owe?
They know the hundreds of thousands and the millions figure. They don't know the tens and the ones. So someone might owe 900 and something. It's like, it's around 930, 940.
Right.
You find out it's 960,
Yeah, or you found out it's 900.
Exactly. Yeah, so a lot of people don't know to the tens of the thousands, but a lot of people know to the, 1.2.
I think it'd be interesting for people to look because, you might have a property worth 2 million, think you owe 1.5, you could actually owe 1.3, you've got great equity in it. Yields are high. It's a great time to buy a free investment property. I think the thing with a lot of people is they don't realize how easy it is to grow on the property ladder, especially when you have a bit of equity in your property.
100%. Having equity is also opportunistic right now because you get a pre-approval to buy another property in times like now.
That's exactly what I'm saying. It's a great time.
So let's talk about opportunities. What markets do you like? What are you seeing where you mentioned price points, but are you talking across the board everywhere you operate? And maybe we should highlight where you operate for that price point?
I mean, we're in Sydney, Melbourne, Brisbane and Perth. What do I like? I like anything blue chip that's always going to have a reason for growth, even if the market doesn't grow. And by that I mean whether it could be infrastructure reasons, it could be location reasons. You know, if you're going to buy an apartment and it's close to a beach or close to a village, it's got a reason why people want to live there. They're always going to want to rent there. You know, it's in an area where there's not going to be major redevelopments. You know, I like those sort of opportunities. And if you can find properties like that are good deals, they're always going to be great long-term holds.
When you say major redevelopments, are you talking about, you know, mass?
Like I wouldn't buy in Zetland or Moore Park, right?
Yeah, as in major developments of huge supply of units.
Correct. You know, if you're in Wallara or Bondi or, you know, Darlinghurst, I like areas for different reasons.
Or pockets of the North Shore or Northern Beaches.
100% Cremorne, Northern Beaches.
Yeah. Where they can't
stuff.
They can't go build a 50-story tower and add 400 units or something to the
100%.
marketplace, which is it's the problem in Sydney, right? The problem is just a constant lack of supply to demand. Demand can never be met by supply in Sydney. So it's a good point. So it's funny that you highlighted Alexandria, Zetland. That's actually an area where banks have issues lending because of the amount of supply. Same with certain pockets like DY. They've got sort of LVR restrictions because of the supply of new units. So stay away from those areas is your advice.
And my advice then is look for properties you can add value to. You know, find something that has the fundamentals: 2 beds, a balcony, sunlight, parking, whatever it might be, something unique about it, and add some value to it, paint, carpet over time.
Which is funny right now. That's not what people are doing, right?
But they don't realise how easy paint and carpet is. Like, to rebuild is not what people should do because it is very expensive and very hard. But to do cosmetic facelifts on properties is super easy.
But don't you feel, and correct me if I'm wrong, but my personal understanding from the front line of our business is that sometimes people don't see through that cosmetic facelift that they could do, right? As in,
that's why it's an opportunity.
Yeah.
That's why I like it, because typically you're going to buy it cheaper, right? And you'll turn it into one of the properties that people get emotional about and overpay. You don't want to be the people who overpay because something looks pretty, and then settlement day comes, all the nice furniture's gone, and you're like, what the hell have I bought, right?
So, and if we look at the top end of town, I know you said the top end of town's like the 10 million plus, but let's say the top end's the 5 million plus. The top end of town is definitely doing that, right? The 5 million plus, they're wanting the renovated houses that have all the bells and whistles already there, so they can just walk in, set and forget. Because a lot of that top end of town, the individuals themselves are quite time poor and they can't be bothered with doing even a cosmetic renovation.
Finished products in the high end are going for huge prices. They're the ones that are flying out the door. It's the ones that need work that are sitting around longer.
Yeah, definitely.
But that's also because it's longer to build and more expensive to build at the moment.
Yeah, we should, and just to touch on that, everyone's saying it's just because building materials have gone up drastically. It's not just the cost of building that's gone up. There's shortages on supply which drag out time frame.
You
right?
Can't get anything.
Yeah, and so at certain stages of the build, the build is on pause whilst they wait for the next material to come in. The other issue that a lot of builders are complaining about is staff. Through COVID, they had low staff levels. Still, right now, many industries are suffering with low staff levels, and on top of that, this El Nino, we've had more rain in 3 months than we normally have in a year.
And on top of that, I think you'll find a lot of them were doing fixed costs and they're burning.
Yeah, we're seeing some builders sort of file for insolvency because of that. A lot of them just can't honour the fixed price contracts, and especially some of the big builders that might do a couple hundred homes at once.
Metricon.
Yeah. All right, so Simon, you had some interesting data here on days on market, median days on market, average days on market for most property, and also volume of listings. So we'll share that, and love to get your commentary on that.
So for everyone out there who's not in the real estate world like us, days on market is the number of days a property sits on the market between listing and selling. And what this graph will show is it was an average of 20 days which is pretty quick. Days on market were almost 3 weeks from listing to selling. Days on market now are 28 days.
So it's not a huge change.
And that's my point. You're seeing a slight slowdown, but nothing major. Things are just taking an extra week to sell, but they're genuinely and generally still selling.
You can see that days on market change. Well, it was going down leading into 2020 and 2021, and then slight increase, but still not a huge change.
Again, these graphs make them look a lot more dramatic, but yeah.
Well, the decrease is actually leading into 2020, right?
Yeah.
So and this next one, stock listings.
So this is about how many properties are on the market, listing numbers. It's increased slightly, as you can see. It's not a huge amount of property that's come on the market, as you would expect from the media and interest rates and everything people are talking about.
Well, people won't be selling right now if they didn't have to, because obviously the media is harping on about the property market not being the best, and people aren't really. Mortgage arrears rates are at record lows because interest rates are at record lows. So no one's really in an uncomfortable position, forced to sell, right?
100%. But there are always reasons why people are selling, right? They have babies. They get divorced, they get married, people pass away.
They want a bigger house.
They want a bigger house, they want a smaller house, like whatever it may be. And so whatever happens in the economy, it's never going to change the fundamentals of why people need to buy and sell, right?
Mm-hmm.
And I mean, you started this conversation by saying, oh, I'm at the forefront of what's going on. But I would say to you, you're at the forefront too. You know, what are you seeing as far as people trying to get pre-approvals? Is there an appetite for people wanting to buy?
There's definitely an appetite, and the good thing is right now, people that are looking to buy have a higher chance of actually buying. Because through 2020 and 2021, I'd say 1 out of 4 of our clients that will
Pin the needle on the donkey. Right?
Yeah, it was just so hard for them to buy because they were up with such serious competition. You know, you'd go to an open home and they have 20 or 30 groups through sometimes. You know, a property would have 10, 15 serious contract holders. Now there's more around 5. So they've got a much better chance of actually securing what they want. You know, I also say, you know, back to your comment earlier in this podcast about, you know, you're never going to be able to pick the top of the market or pick the bottom of the market, both property, equities and crypto is the new asset class, obviously. Not new, but the one that's definitely the flavour of the year.
Maybe not so much right now.
Not right now. But, you know, you're never going to be able to pick the top of the market. You're never going to be able to pick the bottom. My advice, our advice to all our clients at Shore Financial, we always say the hardest thing to do is actually just find a property that you want to buy, because property also, no matter what price bracket you're in, even the people spending $10, $15 million, they're still feeling like they're compromising in some way.
Yeah.
You know, so the perfect property is the perfect amount of compromise, and finding that perfect amount of compromise is the biggest challenge.
I totally agree. The hardest thing about property is getting into the market. Once you're into the market, it's very easy, right? But the thing I've learned is the longer people wait, the worse it is for them. You know, I have clients who, you know these people, but they sold
they'll remain
3
unnamed.
years ago.
Yep.
And what they could have bought 3 years ago for $8 million is probably $20 million now. Now, the problem is they sold 3 years ago, that place would be worth 3 times the amount also, right? So they've completely screwed themselves.
So I've seen a lot of
Time screws people. The sooner you buy, the safer it is.
It's more dangerous being out of the market.
100%. I've been doing this since 2009, and not once since 2009 has someone ever said to me, Simon, thank God I waited. Not once.
Yeah. So on that note, because you know, the waiting is off the back of interest rates rising is where that's coming from, and people thinking it's going to make such a big difference in the property market. So I think we should actually just highlight how much of difference, you know, these increases actually make. So I'll just share something else here. So this actually shows the May and June increase that we recently saw. What let me just bring that to the full screen. What it actually equates to in two ways. Firstly, what it equates to as a mortgage repayment difference, and what it equates to as a borrowing power difference.
Yeah, I'm interested in, like, if you got $1 million loan, which you actually have up there, how much extra are you paying?
Well, something I prepared earlier.
Look at you. We're on the same page.
We've got two scenarios here. A $500,000 loan, the 25-point increase that we saw in May.
Yep.
That equates to a difference in a monthly repayment of $68.
Yep.
In June, the 50-point increase, which was a big one, was $140.
So is that May plus June?
Or no, that's just each month.
So
each increase.
You're up almost $208.
Yeah, $208. Yeah, the total increase there. That's on a $500,000 loan. Now, on $1 million loan, which is probably more relevant for the Sydney market, because, like you said, you're not really getting a house in Sydney.
You're up $400 a month. You're
up about $400 a month from both increases. That's 75 points.
It's not nothing.
It's not nothing, but as we saw on those slides earlier, people have clearly got the money.
Yeah, exactly. And probably what was a $1.5 million loan, they paid down to $1 million super quick.
And I think also the key message to highlight is that, why is inflation high? Inflation's high because consumer spending is high. If consumer spending is high, that means people have the money to spend.
Absolutely. I mean, I'll be interested to see, because you can't go into Porsche, Mercedes, Lamborghini, Aston Martin, Rolex, Hermes, anywhere and buy anything at the moment.
No,
I'll be interested to see if this rectifies that a bit, or people still have the cash to pay these watches are 4 or 5 times what RRP is. Cars are insane.
Cars saw 20% inflation last year, both second-hand and new cars.
Second-hand cars are insane.
I love those retailers you just labelled off, though. They must be where you've been shopping. Porsche, Mercedes.
You can't shop. You can't shop.
Yeah, no, it's definitely an issue.
And I'm not going to pay more for a second-hand car.
No, but some people did. Some people. I know. It's funny. A lot of people bought a brand new car, which they sold later for more than they paid.
Yeah, I could sell my car for more, but what do you buy?
Yeah, you're going to pay more on something else. So the other slide to touch on was this sort of data on how much does the average increase actually affect borrowing power. So actually, sorry, not the average. We're using a forecasted rate where we see rates going in the next 2 years of 4.69%, 2 to 3 years, let's say. That's probably where rates will go. We've got some data here on the forecast of the.
So that same $1 million loan, if in 3 or 4 years the worst case scenario happens, how much has it increased?
No, this isn't the increase. This is showing what people's borrowing power has increased.
Oh yes. If I throw a question at you,
yeah.
That same $1 million loan we looked at, on your worst case, which is the thing you said was 4.69%, rates going to.
This is 4.69%.
Yep. Well, how much extra would that be a month?
So, look at.
I'm putting you on the spot here.
Yeah, let's assume that the average variable now is about 3%. That's about right. And so we've probably got another 1.7% to round it up, being conservative. So that's an increase of about $17,000 a year in interest on $1 million loan.
Okay.
Yeah.
It's about another $1,000-something bucks a month.
Yeah.
Worst case.
Worst case. Which, like you said, it's not chump change. It's something. And also on an owner-occupied residence, that's net after-tax money.
I was about to say.
Yeah.
You got to remember, you got to pay tax. You got to,
Yeah. So it's
earn $36,000.
Yeah, it's not just reducing your or 36,000 if you're in the top tax bracket, but that the Liberal government
30,000 or whatever.
The Liberal government made one quick had one last change that's going to help everybody. I think before they got out of administration, they in their budget, the last budget they did, they actually decreased income tax to 30% up to 180 or 200, I think it is. So,
yeah, wow.
So that's going to come into effect shortly, which is a good
That'll help people.
That's going to be.
I want to talk about something after this too, which is if they abolish stamp duty.
It's funny. Our minds went to the same place. I was just about to minimise that. Let's talk about that. So, how do you feel about stamp duty being abolished?
I did an interview with this yesterday, actually. So the way I understand it is, it's it'll be abolished, and then you're paying a minimal annual fee for your property, like call it a land tax, right?
It varies. So
Yeah.
yes, there's you pay an annual tax, which is like they do in America. On similar to the current land tax, but it's a higher percentage, and there's a fixed amount of, say, I think it's around $1,500 plus a percentage. Look, in my opinion, the government doesn't just cut tax for no reason.
No, they'll be making it up somewhere else 100%. But if I'm talking generally, I think it'll stimulate the market because I think what it will do is it'll increase prices by 5%. But, and you're probably better to speak at this than me. Well, I know you're better to speak at this than me. But you typically, if you want to be safe and not a cowboy or you're not a doctor, typically stamp duty is an out-of-pocket expense, right?
And it's once off though.
Yeah, but it's cash you have to have. You can borrow more, so it doesn't really matter if the purchase price is 5% more, rather, taking stamp duty out. Does that make sense?
Yeah, no, I know where you're going. So it's a valid point. It will make the market rally slightly because people just need less money to actually buy. Your total deposit, your total cost of funds for the purchase is less because you don't need to factor in that 4.5. It actually tiers up stamp duty.
It's 7% over 3 million. Or something like that.
Yeah, so you don't need to have that in your funds to complete anymore.
That's what I'm saying.
It's
a big saving.
It will help. I also think it will help long term from a stock level point of view. Now, this when I say long term, we're talking 5-10 years down the track. The reason being is because people are going to be less inclined to keep a property as an investment when they move out. Now, one thing I've noticed in the last 5 or 10 years, with interest rates steadily declining, people, when they upsize from their 2-3 bedroom apartment or their little sort of semi or terrace, they, if they could afford it, and with low interest rates, they generally could, they kept it as an investment, and the rent normally covered the mortgage repayment. With rates rising, that'll be questionable whether the rent covers the mortgage repayment. However, with an extra property tax that's taking a good chunk of your net yield, and that property tax also increases for investors.
So is that property tax going to come into effect on properties you already own?
No, they'll grandfather it. Because you've already paid stamp duty, so they can't make it retrospective, because then it's like, hey, well, I'm paying twice the amount of tax. But investors that buy property moving forward, so I think the figure was 0.1% for owner-occupier. I think it's about 1% for an investor, and for commercial purchases, it will be 2%. Or 2.5% maybe even per annum. The reason why they've done the 2.5% for commercial purchases is, I think, purely targeted at developers, because sometimes they only own the property for 2-3 years before they sell it.
Yeah.
So they want to still make sure they're getting.
It screws the long-term investors.
It screws the long-term investors. So we'll probably see commercial property that is not a development site have a bit of sort of price compression there, because it's going to really hurt your yields.
Yeah.
A lot of business operators will hurt with that. It's been on the cards for a long time.
It's like the airport. The second airport. You never know if it's going to happen or not.
Yeah, they keep bringing it up, but I'm not sure when it's actually going to come into power. The other thing to talk about, and when we're talking about changing in taxes, this one's a hot topic actually, is negative gearing and capital gains tax discounts and exemptions. 3 years ago in the last federal election, the Labor government were very, strong in their views on abolishing both negative gearing and capital gains tax discounts and exemptions. Now, to highlight for our listeners that don't know what the capital gains tax discounts and exemptions are, because many people don't, the exemption is the exemption you get on your primary residence, meaning that at the moment you don't pay tax on the growth on your primary residence. I'm hearing from a lot of major accounting firms that might not last forever, that you will pay tax on the growth of your home, because if you're benefiting from our economy, then you should be paying tax on it.
I think that's a joke. I mean,
and now the discount.
Property in Australia is about making money.
Yeah, it's one of our favourite asset classes as Australians. The discount with capital gains that no one is quite across is that if you hold any assets, so it could be shares, it could be business, it could be property, if you hold the asset for more than 12 months, you get a 50% discount. So capital gains tax is normally your income tax. So you're in the top tax bracket, call it 48 cents to the dollar. Well, also the capital gain that you'd make that year would probably put you into the top tax bracket regardless. So it should be 48 cents tax. However, you get a 50% discount, making it 24%. So everyone thinks capital gains tax is 24. If the discount isn't there, it becomes 48.
Yeah, wow.
Percent or 48 cents to the dollar. So there are potential changes on the cards. I believe
chat's getting real doom and gloom. Huh?
I'm now sounding like
interest rates
7,
don't
9,
bother
10,
me,
right?
but this stuff I don't like.
Yeah. Well, look, tax on growth is tax on profit, so you've made money, right?
I know.
Um,
I still think you buy and hold.
all right, Simon. So I think we've covered some good sort of high level data there. Some macroeconomic stuff you could say on what's going on with the global economy, because it is relevant what's happening around the world, not just here locally, because it's impacting us what's happening overseas. But I think the best thing that we could do by having you in house here and speaking to our listeners is give some advice. Talk about what would your advice be for buyers out there right now, and what would your advice be for vendors out there right now?
My advice for vendors, because I'd start with them, is don't be greedy. Forget about the last 2 years. That was a point in time.
Good advice.
If you didn't take the opportunity to sell at that point in time, it is a different market.
Before you go to buyers, and can we elaborate on that? On don't be greedy. What it's resulting in. I'm personally seeing a lot of vendors be too greedy, and it results in an even worse price for them because they're holding out, and it becomes a stale listing, right?
There's a saying. It's a stupid, simple saying, but sometimes your first offer is your best offer. And we haven't seen that in a long time until recently. Vendors are getting great offers in the beginning. They're greedy because they've seen what's happened over the past 2 years, and they end up selling for less.
I think it's also important to use bank valuations as a bit of a guide to what's realistic at the moment, because there is definitely a softening in the marketplace. In recent years, up until recently, so the last 3-4 years, properties were selling for quite a bit more than bank valuations.
Much more.
Now they're selling for around bank valuation. So I think if you've got a bank valuation from your last application, or you've got a bank valuation from your current application, that should be your benchmark on what you should be expecting as a sale price. Correct?
Correct, but the market's still the market,
and
a bank val's not going to tell you how much competition or how little competition there may be. And often they don't take into factors such as finishes, replacement costs, which I've seen, because it's so expensive to build now that something finished might be worth more than what they think. But it is a great benchmark, but often you'll get a bank val and it'll either sell for a lot more or a lot less. You just don't know.
And that's so that it's case by case, to your point, and that's why getting advice from the right people is really important. I feel a lot of people unfortunately don't trust real estate agents, but sometimes taking their advice is crucial.
They know the market, they know the buyers, and when a property is going to be hotly contested or not. And so you've got to find a real estate agent you trust and go off their advice, because that's their job.
Now, on the flip side, buyers, what's your advice?
So, to not bore everyone and to sort of sum up where I think we are in the market right now, we're in a position where you don't know if something's going to be crazy or if something's going to be super cheap, right? And so I think my advice to buyers is really understand your market. If you're not using someone, really understand your market. And the best way you can do that is by going to open for inspections at comparable properties you're looking to buy, and by going to auctions for comparable properties you're going to look to buy. And you're going to learn a lot from that. But mostly what you're going to learn is the appetite for those sort of properties. And you're going to walk through a home and you're going to know if it's hotly contested or if it's not, right? And you're going to get a feel on whether you should make a pre-auction offer or you should wait for auction, right? And so my advice is really understand what is happening in the area you're looking at buying in, because you don't want to be the schmuck in this market that paid 20% more than you had to for a property, because there are deals out there and you should be looking for those deals, right? And so I'd be really researching where you're looking to buy. I know our buyers agents spend all day, every day in their markets. So I know if I go to an open home on a Saturday or Wednesday or Thursday, and I only go to open homes to see the competition, because typically I would have seen them before, I get a feel to know if it's going to go crazy or not.
It's funny. Sometimes though, when you go through a property, people think it's hotly, contested, but 60-70% of the buyers in the open home could be curious neighbours.
100%. But then it comes down to monitoring the property. If the agent's calling you a lot and pushing you to make an offer, you're going to get a feel that there's a little bit of desperation. But my advice is ask questions. Theo, why is the vendor selling? Have they bought something? Would a quick settlement appeal to them? Have they not bought? Would they want to rent? Is there motivation? Find out the reasons why the owner is selling and try use those reasons to your advantage rather than paying more money.
I love that advice. Something you're basically saying in a nutshell is that knowledge is wealth, right? And a lot of people underestimate how much they can absorb themselves as the buyer. Look, I obviously love to recommend speaking to a buyer's agent, but the consumer themselves, the buyer themselves, can actually do a lot of research to just know, hey, out of the last 10 properties I've seen in this marketplace, this one, yes, it's got XYZ compromise, but it seems like a lot better value than those last 10 I saw. So they can do a lot of that research to get a lot of that confidence themselves, right?
Absolutely. If you're doing it on your own, you've got to do the research. You've got to ask the questions. I bought a house on Friday. I was able to match the highest offer and not pay more for it because I asked some questions. I found out some things that weren't money related that were able to make our offer more attractive, right? And that meant we didn't have to pay more. We could just match the highest offer and get the property. It's those things that are going to get deals across the line and save you money. I know most of what we buy is off market. If you're doing it yourself, try and get access to those opportunities. They're typically motivated vendors.
You mentioned something there that I want to open up off market. What is the actual percentage of transactions you're seeing off market? Is it more the high end with the rich folk that don't want to open up their house to the general public so the curious neighbours can't see what they did with their backyard?
In my firm, in our Sydney office, it's 85%.
Wow.
In the marketplace, I think it's around 50%. In my other offices, it differs.
So why would, this is maybe advice for both buyers and vendors, why would someone sell off market when they might be limiting themselves on how many buyers are coming through?
Well, pre-COVID, when it was around 50% in our company, it was they had young kids and didn't want to get the house ready. They didn't want to spend money on marketing. They were elderly.
And when you say
they were getting divorced, they had bought and they want to sell super quick. Financial issues. Sorry, you interrupt you.
Well, when you say that they have kids and don't want to get their house ready, people need to realise it's getting their house ready.
Sorry, let me elaborate on that. 3 times a week, getting your house show ready. Like, I live alone and I've sold, which I should never have done. Never sell, hold everything. But
that's a great thing.
Yeah, I'm not Greek. But, you have to, after the shower, bloody wipe the shower down. It's tiresome. It's time consuming. It is a nightmare, right? And you've got people going through your house. It is very inconvenient. And that inconvenience is a huge factor for people. And that's what and then when you have young kids, it makes it even worse. If you're elderly, it makes it even worse. So it's all of these factors that make it very difficult. Since COVID, where it's increased in our firm about 35%, people just want less and less people in their houses. We've become scared of crowds. We've become scared of having a lot of people through our home. And this one-on-one mentality has made things a lot easier.
It's funny. That's a really good point because, even from a financing point of view, we've had clients who need our help for finance and they need the bank to do a valuation on their property, but they're hesitant to let a valuer come through because they think the value is going through people's houses all the time.
Well, imagine having 1,000 randoms through your house.
Yeah, and so they try and make us, convince the bank to do an electronic valuation. It's like, listen, just let the valuer through. He's wearing a mask.
I'm not talking shit here. Like it's just our it's the world's mentality now.
Yeah. Well, that's some great advice there, Simon. We've covered some great topics. Thank you for taking the time. I know you're very
Thanks for having me. Always good to catch up.
Person, you're on the camera a lot these days.
Only in the Shore Financial podcast room, clearly.
For all the listeners that also follow you personally and love watching the TV series. Can I ask when's the next one coming?
October, November. I can't give an exact date, but end of this year.
And is it getting better and better?
I haven't seen it yet, so I don't know. But all the producers tell me it's very good. It's the best season yet. So time will tell.
For people that don't know what we're talking about, Simon is the buyer's agent from Lux Listing. Great show. I think it's putting Sydney on the map globally. It's really good. It's a great production. And I think Amazon are claiming it's one of their best TV series. So tune in to watch Simon in action.
Thanks, mate. Thanks for having me.
Thank you.